There are three specific assets sitting inside retirement accounts right now that the IRS has made a priority target in 2026. Not because the people who own them did anything dishonest, because the rules surrounding these assets are complicated, the marketing around them is often misleading, and the consequences of getting it wrong are not a small penalty or a correction letter. The consequences are the complete destruction of the tax-protected status of the entire account. Asset number one is inside millions of self-directed IRAs right now, and a brand new IRS reporting system that went live in 2026 is creating automated mismatches that the agency's AI is flagging for audit without a human reviewer ever looking at the file. Asset number three is the most commonly held alternative investment in self-directed IRAs in America, and a single conversation with a family member, a single transaction involving someone you love, can void the entire retirement account without warning. But asset number two is the one this video is named after. Because asset number two is something that hundreds of thousands of American retirees were told was completely legal. They bought it with their retirement funds. They documented every purchase. They labeled every piece carefully. Some of them even set up a legal entity specifically to hold it. And the United States Tax Court has ruled, definitively, on the record, with a dollar amount attached, that every single one of those people triggered a fully taxable distribution the moment they put that asset in their safe at home. The taxes and penalties in one case alone exceeded $300,000. On money that was supposed to be protected inside a retirement account. On an investment the account owner genuinely believed was legal because someone told them it was. Today I am going to walk you through all three of these assets. What they are, exactly what the IRS rule is, what the real dollar cost of the violation looks like, and what you need to do right now in 2026 if any of these assets are currently sitting in your retirement account. This is not a general warning about self-directed IRAs. This is not based on a headline or a podcast someone forwarded you. This is based on actual IRS code sections, a landmark United States Tax Court ruling, a brand new IRS reporting form that went live this year, and the exact prohibited transaction rules the agency is using right now to audit self-directed IRA holders. Every dollar amount, every legal citation, and every compliance consequence in this video comes directly from government sources and official court records. We are putting real numbers on what these violations actually cost, so you know precisely what is at stake. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional or tax attorney before making any decisions about your specific retirement account situation. My name is John Retires. Every week I break down the IRS rules, the tax traps, and the retirement strategies that protect your income from the things nobody else is sitting down and explaining clearly. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Before I get into the three targeted assets, let me quickly explain what a self-directed IRA is, because everything in this video hinges on understanding the difference between a standard IRA and a self-directed IRA. A standard IRA at a traditional brokerage holds stocks, bonds, mutual funds, and ETFs. The brokerage manages the custody of those assets. The rules are well understood, the custodians are experienced, and the compliance infrastructure is mature. A self-directed IRA, commonly called an SDIRA, allows the account holder to invest in a much broader range of assets: real estate, private equity, precious metals, cryptocurrency, private loans, and more. The appeal is obvious. You are not limited to the stock market. You can put your retirement money into assets you understand and believe in. But the expanded investment universe comes with a critical trade-off. The IRS places the compliance burden squarely on the account holder. You are responsible for knowing the rules. You are responsible for ensuring every transaction is legal. And when the rules are violated, even unknowingly, the consequences are not proportional to the violation. They are total. The entire account can be disqualified. The entire balance becomes a taxable distribution, in the same year, all at once. That is what makes these three targeted assets so dangerous in 2026. The penalties are not small, they are catastrophic. Let me start with asset number one, because this is the one that is creating new risk right now, even for people who have been handling their crypto IRA correctly for years. Starting in 2026, the IRS introduced a requirement to file Form 1099-DA, the first ever IRS form focused specifically on crypto and digital assets. This new IRS information return is used to report proceeds from certain digital asset transactions, including sales, exchanges, or other dispositions of cryptocurrency and non-fungible tokens. Like other forms in the 1099 series, Form 1099-DA provides the IRS with third-party reporting that can be matched against a taxpayer's return. Here is why this matters specifically for people with crypto inside a self-directed IRA. Your SDIRA custodian files Form 5498 every year, which reports the fair market value of the assets in your retirement account. That form has always existed. What is new in 2026 is that crypto brokers and exchanges are now simultaneously filing Form 1099-DA, reporting your transaction data directly to the IRS from their side. Under the final regulations, brokers must report gross proceeds for transactions effected on or after January 1, 2025. Brokers must report on a basis on certain transactions effected on or after January 1, 2026. So now the IRS has data coming in from two directions at the same time. Your SDIRA custodian is reporting one set of valuations. Your crypto exchange is reporting another set of transaction data. Differences between reported proceeds and amounts reflected on a tax return may prompt IRS follow-up inquiries, particularly for taxpayers who frequently transact or use multiple platforms. The problem is that the valuation methodologies do not always align perfectly. Crypto assets are volatile. The fair market value your custodian reports on Form 5498 on a specific date may not match the transaction data the exchange is reporting on Form 1099-DA for activity throughout the year. If the cost basis is not reported on Form 1099-DA, the IRS may assume it is zero, which could lead to tax notices for underreported income. And here is what happens when those numbers do not match. The purpose of Form 1099-DA is to bring greater consistency to digital asset reporting, close long-standing information gaps, and improve overall tax accuracy. As digital assets become more integrated into the financial system, the IRS is placing increased emphasis on transparency and standardized reporting. The agency's automated matching systems are specifically designed to catch discrepancies between what custodians report and what brokers report. A mismatch does not go into a pile for a human reviewer to look at later. It triggers an automated flag. That flag can initiate an audit process before you have any idea there is a problem. Let me put a dollar amount on what this means. A retiree holding $50,000 in Bitcoin inside a self-directed IRA made several trades throughout 2025. Their custodian reported a year-end fair market value on Form 5498. Their exchange reported the transaction details on Form 1099-DA. The cost basis methodology the custodian used and the methodology the exchange used produced different numbers. The IRS automated system flags the discrepancy as potential underreported capital gains. An audit opens. The account holder now needs documentation to reconcile every transaction across both reporting systems. Documentation that most people holding crypto in an SDIRA have never been told to maintain. The audit does not necessarily result in a disqualification of the IRA, but it results in back taxes on any underreported gains, accuracy-related penalties of 20% of the underpayment, and potentially interest compounding from the date the tax was originally due. Taxpayers are required to report items of income, gain, and loss on their digital asset transactions that trigger a realization event, regardless of whether they receive a Form 1099-DA and whether a broker has custody of the digital assets. Likewise, taxpayers should maintain records to substantiate their tax returns. If you hold cryptocurrency inside a self-directed IRA, what you need to do right now is contact your SDIRA custodian and request a reconciliation of their Form 5498 reporting against your exchange's Form 1099-DA data for the same period. Do not wait for the IRS to find the mismatch and contact you. Find it yourself and resolve it before the automated system does it for you. Now we get to asset number 2, the one hiding in your safe. And I want to be careful here because this is the most important section of this video and also the most misunderstood issue in the entire self-directed IRA space. Physical gold, silver, platinum, and palladium are legal investments inside a self-directed IRA. I want to say that clearly before I explain what makes them illegal. The metal itself is not the problem. The storage is the problem. And that distinction, permitted metal, improper possession, is the line that has destroyed hundreds of retirement accounts. For years, aggressive marketing campaigns across television, radio, and the internet promoted what became known as the Home Storage Gold IRA. The pitch was simple. Buy physical gold with your retirement funds, set up a limited liability company to hold the metals on behalf of the IRA, keep the gold in a safe at your home, and your retirement funds are protected in physical precious metals you can see and touch. It sounds reasonable. Millions of people believed it, and every single one of those people was given information that directly contradicts the Internal Revenue Code. The tax court decision in McNulty versus Commissioner directly addressed how physical possession of precious metals is treated under Internal Revenue Code Section 408M when those metals are held in or purportedly held by an IRA. Here is what happened in that case. A couple stored $411,000 in American Eagle gold and silver coins in a home safe through an IRA-owned LLC structure, per the U.S. Tax Court ruling in McNulty versus Commissioner 157 TC No. 10, 2021. Donna McNulty argued unsuccessfully that she had opened a separate bank account in the name of an LLC, documented the purchase of coins, and labeled the coins as the property of her IRA-owned LLC when depositing them into her home safe. None of that documentation mattered. None of that mattered because the judge ruled that physical possession of the coins constituted unfettered control. Because the metals were not held by a qualified trustee, the IRA was deemed to have distributed the coins to the taxpayer in the year of purchase. Let me put a dollar amount on the consequence. The entire IRA balance was treated as a taxable distribution, resulting in nearly $270,000 in taxes, plus additional penalties. Their total exposure exceeded $300,000 because they had relied on a promoter's website that advertised home storage as legal. $411,000 in an IRA, $300,000 in taxes and penalties, on an investment they genuinely believed was structured correctly, on metals they had documented, labeled, and organized in an LLC specifically to protect. One of the most important clarifications from McNulty is that an IRA LLC does not override the physical possession requirement in Section 408M. Permitted metals plus improper possession equals prohibited investment. That distinction is crucial for self-directed IRA investors. The law under Internal Revenue Code Section 408M is explicit. Your IRA can hold gold, silver, platinum, and palladium, but those metals must remain in the physical possession of a qualified IRS-approved third-party trustee or depository. Not your home, not your bank safety deposit box, not an LLC you created and controlled. An independent IRS-approved institution with no connection to you personally. The court stated that independent oversight by a third-party fiduciary to track and monitor investment activities is one of the key aspects of the statutory scheme. When coins or bullion are in the physical possession of the IRA owner, in whatever capacity the owner may be acting, there is no independent oversight that could prevent the owner from invading retirement funds. This lack of oversight is clearly inconsistent with the statutory scheme. Personal control over IRA assets by the IRA owner is against the very nature of an IRA. Now here is what makes this even more dangerous in 2026. For several years, false advertising in the form of television, radio, and internet promotions has suggested that buyers could store assets of gold and silver bullion coins in their own homes or safety deposit boxes as part of an IRA account. Those promoters are still operating, those advertisements are still running, and retirees who responded to those advertisements years ago may still be holding IRA gold in a home safe right now, without any idea that the clock started on a taxable distribution the moment the metal crossed their threshold. If you want physical gold in your retirement plan, use a properly structured gold IRA with an approved depository. If you want physical gold in your home, buy it with after-tax money. These are two separate goals with two separate solutions, and trying to combine them into one structure is what creates the tax liability. If you are in this situation right now, if you have IRA gold or silver in a home safe, a personal safety deposit box, or any storage location you personally control, you need to speak with a qualified tax attorney before you do anything else. The McNulty ruling is clear, the IRS position is clear, and the longer the metals stay in personal possession, the larger the taxable distribution the IRS can calculate. Asset number 3 is real estate, the single most popular alternative investment inside self-directed IRAs in America. And unlike cryptocurrency, where the new risk in 2026 is a reporting system, and unlike gold, where the risk is physical possession, the real estate risk is something far more personal. It is the risk of doing something natural, logical, and instinctive, and having the IRS treat it as a complete destruction of your retirement account. The rule is called the Prohibited Transaction Rule, and it lives under Internal Revenue Code Section 4975. Here is the core of it. Your self-directed IRA is not an extension of you. It is a completely separate legal entity. The IRS treats your IRA the same way it treats a pension fund or an institutional investor, as an independent entity with its own interests that must be managed at arm's length from the people connected to it. Under IRC Section 4975, you, your spouse, your children, your parents, and certain business entities you control are classified as disqualified persons. The IRA cannot transact with any disqualified person in any way that benefits them. And in the context of real estate, the definition of a transaction is far broader than most people expect. You cannot live in a property owned by your IRA, not as a primary residence, not as a vacation home, not even for one night. You cannot rent an IRA-owned property to your adult children, your parents, or any other disqualified person, regardless of whether the rent is at fair market value. You cannot personally perform repairs or maintenance on an IRA-owned property, not even minor repairs. The IRS calls this sweat equity, and it is treated as a prohibited transaction because it represents you providing services to the IRA for which the IRA does not compensate you at arm's length. Every dollar spent on the property must come directly from the IRA's cash account. Every dollar of rental income must flow directly back into the IRA. No exceptions, no pass-throughs, no temporary borrowing even if you intend to replace the funds immediately. Let me put a dollar amount on what a single violation costs. A retiree holds a rental property inside their self-directed IRA worth $400,000. The tenant moves out in October. The retiree, rather than hiring a contractor paid from the IRA cash account, personally repaints the property over a weekend. The total cost of the paint was $300. The labor, in the retiree's mind, was free. The IRS does not see free labor. The IRS sees a prohibited transaction, the IRA owner providing services to the IRA without arm's-length compensation. Under IRC Section 4975, a prohibited transaction in an IRA does not result in a penalty on the transaction. It results in the disqualification of the entire account. The entire $400,000 property is treated as distributed to the account holder in the year the prohibited transaction occurred. Ordinary income tax on $400,000, at whatever tax rate applies, plus a 15% excise tax on the amount of the transaction, on a single weekend of painting. That is what the IRS means when it says the IRA is a separate legal entity. It is not a legal technicality. It is the difference between a $400,000 retirement asset and a $400,000 tax bill. Here is what the IRS is specifically auditing in 2026 in the real estate SDIRA space. The agency has identified a pattern of self-directed IRA real estate owners who blur the line between the IRA's property and their personal use of that property. Vacation rental properties that the IRA owner uses during off-peak weeks. Properties rented to a child at a slight discount because the parent wanted to help. Repairs performed personally because the owner was already at the property and it seemed wasteful to call a contractor for something small. Every one of those situations, when discovered in an audit, has the potential to trigger a full account disqualification. Now you are probably thinking, the solution is simple. Just avoid these three assets inside your IRA and you eliminate the risk entirely. That makes total sense on the surface. But here is what actually happens when retirees make decisions based on that logic alone. Avoidance is not always the right answer. Cryptocurrency in an IRA can be held compliantly with proper custodianship and documentation. Physical gold in an IRA is completely legal when stored at an approved depository. Real estate in a self-directed IRA has generated significant returns for thousands of retirees who manage the compliance correctly. The assets themselves are not the problem. The compliance failures around the assets are the problem. And for people who are already holding these assets in an IRA right now, avoidance is not an option retroactively. The question is not whether to hold them. The question is whether the current structure is compliant, and what to do right now if it is not. Here is what changed in 2026 that makes this issue more urgent than at any point in recent memory. Brokers must report on the basis of certain transactions effected on or after January 1, 2026. This is the change that specifically escalates the cryptocurrency risk described in asset number 1. Full cost basis reporting flowing from crypto brokers directly to the IRS means that every discrepancy between what your custodian reported and what your broker is now reporting becomes visible to the IRS's automated matching system simultaneously and immediately. 7. Basis reporting becomes mandatory for covered securities beginning in 2026. This means that unlike 2025, where basis reporting by brokers was voluntary, 2026 creates a mandatory data pipeline directly into the IRS matching system. The transitional period is over. The full enforcement infrastructure is now active. For precious metals, the McNulty ruling has been settled law since 2021, but the number of retirees still holding IRA gold in personal storage under the belief that an LLC structure protects them has not declined proportionally. The IRS knows this. The promoters who sold these arrangements are still identifiable through their marketing records. Enforcement in this area has not decreased. For real estate, the IRS Priority Guidance Plan has specifically identified self-directed IRA prohibited transactions involving real property as an ongoing compliance priority. The agency is actively auditing SDIRAs where the owner has a history of transactions connected to disqualified persons. And the One Big Beautiful Act introduced the new $6,000 senior bonus deduction for taxpayers 65 and older with modified adjusted gross income under $75,000 as a single filer or $150,000 filing jointly. This matters in the SDIRA context because if a prohibited transaction disqualifies your IRA and forces a large taxable distribution in 2026, your adjusted gross income in that year almost certainly exceeds the threshold for the senior bonus deduction, the Social Security tax protection thresholds, and potentially triggers the Medicare IRMAA surcharge on top of the income tax. One compliance failure compounds across multiple tax consequences in the same filing year. The $6,000 deduction you were counting on disappears. The Social Security taxation climbs. The Medicare premium surcharge activates, all from a single prohibited transaction. Here is what this all comes down to. If you hold cryptocurrency inside a self-directed IRA, contact your custodian this week and request documentation of how they are reconciling your Form 5498 valuations against the Form 1099-DA data that crypto exchanges have now begun submitting to the IRS. Ensure that every transaction in your crypto IRA has a documented cost basis. Do not assume the custodian and the exchange are producing consistent numbers. Verify it yourself. Reviewing transaction histories, identifying which platforms may issue Form 1099-DA, and understanding how those amounts flow through the tax return can help prevent surprises at filing time. If you have physical gold, silver, or precious metals in a self-directed IRA, the first question you must answer right now is where those metals are physically stored. If the answer is anything other than an IRS-approved third-party depository that is completely independent from you personally, you have a compliance problem that needs to be addressed immediately with a qualified tax attorney. Not a financial advisor, not the company that sold you the arrangement. A licensed tax attorney who can advise you on the specific remediation options available before the IRS finds the arrangement on its own. Documentation and proper custodial control remain essential to preserving an IRA's tax benefits. If you hold real estate inside a self-directed IRA, the most important thing you can do right now is conduct an honest review of every interaction you have had with that property over the past 3 years. Has any disqualified person ever used the property? Have you personally performed any work on the property, regardless of how minor? Have any expenses been paid from your personal funds rather than directly from the IRA account? Have any rental proceeds passed through your hands before going back into the IRA? Any yes answer to any of those questions warrants an immediate consultation with a tax attorney who specializes in SDIRA compliance. The golden rule of self-directed IRA investing is this: ownership does not equal custody. You can direct the investment strategy of your IRA. You can decide what to buy and when. But an independent, IRS-approved third party must hold the physical and logistical control of the asset. The moment you or anyone connected to you takes personal custody, personal use, or personal benefit from an IRA asset, the IRA loses its protected status. And the IRS does not offer a proportional penalty. They offer a total disqualification. The retirees who protect the most wealth inside a self-directed IRA are not the ones who found the most creative investments. They are the ones who understood where the compliance lines were before they crossed them, and structured every single transaction to stay clearly on the right side of those lines. Now you know exactly what the 3 targeted assets are, why each one creates catastrophic risk in 2026 specifically, and what you need to do right now if any of these assets are currently in your retirement account. But there is one more piece of this that changes the entire calculation depending on how your IRA is structured. The state you live in determines what additional tax exposure you face if an IRA disqualification forces a large distribution, because some states tax that distribution as ordinary income at the state level on top of the federal bill. Watch my video on the best and worst states for retirement income taxes. I break down exactly which states would compound the damage of an IRA disqualification and which ones would not add a single dollar in state tax on top of what the IRS already took.